I'm in year 3 of an expansion that is now got a hostile Federal Reserve, which I don't think is going to stop. It's got elevated inflation, and it still has a lot of restructuring to go through. I'm not so sure that, paying up fully valued or slightly more than fully valued is what I want to do in this environment. Anything to do with AI, whether it's NVIDIA or some of the FANG stocks, those things are way out there right now in the bubble land.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with macro and market research analyst Jim Bianco. If you haven't yet watched part 1 of our discussion with Jim, in which he explains why he thinks the Fed could be more aggressive in its policy decisions here than the market is currently pricing in, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes we discuss in this video. All right, let's get started watching part 2 of our interview with Jim Bianco. I just love to get a sense of where you think the markets are going to head from here. Let's look at the rest of the year. Are you sanguine? Are you concerned? From your comments so far of how resilient the economy is, my guess in the fact that you don't see the markets as that overvalued, which may surprise some people when NVIDIA is trading at whatever multiple of sales it is right now.
Well, NVIDIA is way out there. Yes.
Yeah, but it's one of those 8 stocks. I mean, there aren't that many stocks propping the market up, as you said, right? Yeah. So
Right. So to answer your question about where the market is, the problem with saying that the market is above average valuation is it depends on where you think the market's going to go next. I'm fine owning an above average market if I'm in year 3 of a 9-year expansion. But am I in year 3 of a 9-year expansion? I'm in year 3 of an expansion that is now got a hostile Federal Reserve, which I don't think is going to stop. It's got elevated inflation, and it still has a lot of restructuring to go through. I'm not so sure that, paying up fully valued or slightly more than fully valued is what I want to do in this environment. Now that I've said that, that doesn't mean that the market is horribly oversold and it's going to go down. The other problem is you have to definitely break this market down into the 2 major camps, right? Anything to do with AI, whether it's NVIDIA or some of the FANG stocks, those things are way out there right now in the bubble land. And I've been using it in, just stick with that for a second, then I'll talk about everything else. I've been using the historical analogy of Amazon. In 1999, December of 99, Jeff Bezos was Time Magazine's Man of the Year. That's when they were politically incorrect and it was still Man of the Year. And it was because we were going to have this revolution of online retailing that was going to change everything. That was the tagline on the cover. 24 years later, that was right. That was totally right. We did have a giant revolution of online retailing. But what about if you had owned Amazon stock? 24 years later, you would have been very happy that you owned Amazon stock. But if you bought it in December of 99, you would have paid roughly $100 for it, which is what its price was pre-split in 99. By the fall of 01, it was $6. You would have lost 94% of your money. By 2010, it was still at $100. 11 years later, you still didn't make any money. And then it went from $100, that was pre-split, to $3,300 from 2010 to 2021. So I could see 2 things happening at once when it comes to these massive tech stocks. AI is going to fulfill the promises that everybody thinks it's going to fulfill, and it's going to be as revolutionary as the internet itself. I could understand that. And go buy NVIDIA and go buy all those stocks, and in 10 years you're still at a loss. Because they're pricing in that expectation now, and then we have to wait to see it happens, and that's when the stocks wind up tumbling. The rest of the market, I still think is being held hostage by inflation, interest rates, and the general level of the economy. It has been meandering sideways, and it will continue to meander sideways. The problem that the rest of the stock market has is, if you do look at the long-term studies by Ibbotson and the other groups, they would say that long-term the stock market should return 9%. roughly 9%. Well, if I was to believe the Fed, by the end of the summer, I could get 5.5 in a T-bill or a money fund. I could get over 5 now in a money fund without taking any risk.
Any risk.
I get two-thirds of the stock market's return with zero risk. This is a far, far different world than when the risk-free alternative was zero. The risk-free alternative is now 2/3 of what you should long-term expect from the stock market. So that is going to provide a lot of competition for the stock. Cash is no longer trash. Cash is now a legitimate competing force with the broader market as well, because it's going to give you, let's be a little more conservative, 1/2 to 2/3 of what you would expect anyway, longer term. There'll be good years. Last year was a bad year. This year's a better year. You average it out, you're still better off in cash over the last 2 years than you would have been in the stock market. But this is going to be a real problem. So where do I see the market going? I see it, other than those bubble stocks, it's going to continue to struggle. It's going to struggle because it's going to have the weight of higher interest rates, more inflation. The stronger economy is just going to feed back into interest rates and inflation. That's why I want to say struggle and not go down. The bubble stocks, the problem with the bubble stocks is, yeah, they're a bubble. Yeah, they could fall a lot, but I don't know if they fall from this level down or if they go up another 100% before they start to fall. Whenever you get into this detached from reality standpoint, where a NVIDIA is trading at 40 times revenue, 40 times revenue is where NVIDIA is trading right now, which is a number that most people can't understand. And NVIDIA tries to justify it by saying on their call that they think that the ultimate market, whenever they use the TAM, total addressable market, whenever you throw out the TAM term, and they say that, that they could see them selling $1 trillion worth of their chips because of AI. Look, world GDP is $100 trillion. You're telling me that 1% of all economic activity in the world is going to be buying NVIDIA chips? That's, by the way, they sold 40 billion of chips last year. But now they're trying to tell me that soon they'll be at $1 trillion of sales of chips. That is, sure. And Bianco Research is going to earn more than JP Morgan just because I said it. And then I want valuations of my company to be appropriately reflecting that too. So yeah, I don't know, but when you get a company that's 40 times revenue, which is a hard number to fathom as far as the revenues, why couldn't it go to 60? 40 is already so far out there. I don't know why that 60 would be an impregnable barrier. But at some point, it will do like the ARK funds did and everything else, and it will have a vicious correction. I think I just don't know where. But don't confuse the correction with the promise of AI. The other example I'll give you too is in 1929, RCA, Radio Corporation of America, was pretty much doing what NVIDIA was doing now going into the 1929 peak, because radio was going to be this wonderful thing that everybody across the country was going to have. And it fulfilled that. Not only did they fulfill that promise, but then it went to the next step and made black and white TV, and then we made color TV. RCA peaked in 1929. It wasn't until the invention of color TV in the 1960s that it actually took out that level. But the promise that we would have nationwide radio, nationwide television, nationwide color television, that did happen. It's just it took you 40 years to make money on that stock investment. Xerox the same way. In 1973, Xerox was through photocopying, was going to redefine the way that the office works, and they did. And Xerox's stock was such a major Nifty 50 stock that it peaked in 1973 at a level that it was nearly 2000 before it took that level out again. And yet we did redefine the office in a lot of ways that Xerox thought. So keep in mind, the hype of AI can be real and can be justified. The stocks, that can be a completely different story.
All right. So you feel you're seeing echoes of the past here in the current AI enthusiasm that we're seeing.
Yes.
Okay.
I also think that echoes of the past also is a lot of people have learned, a lot of people were skeptical, didn't believe the internet. The famous Paul Krugman line from 1998, it'll be as important as the fax machine by 2005. Yep. I think a lot of people thought that. And now I think what's going on with the AI hype is they're not going to make that mistake again. We're going to buy these hype stocks this time is what they're going to do. Well, you're going to make money for a while, but we'll see how the entire cycle works out.
Right. But then it could be dead money for a long time, a lot longer than you'd like, right?
Yes, exactly.
All right. So just trying to wrap things up here and be respectful of your time because we've already gone over the hour here. It's been a great discussion. As always, Jim, my prediction at the beginning has come true in spades. So let's just talk about bonds for a moment because you talked about Tina, right?
Right.
And you think that the Fed may need to be more aggressive than is currently appreciated, right? So it wouldn't surprise you if the Fed continued raising the federal funds rate from here aggressively, more aggressively than folks think. But looking at some of your recent work here, you've got some interesting contradictions. One, you've got how the bond market and the stock markets have been kind of predicting Fed policy. They've been very different, and the stock market's been wrong a lot more often, even though the market's kind of on fire right now, which is kind of funny. But there's two reports you flag. One is the commitment of traders that show they're the net shortest they've been maybe ever, at least in the data set you had for the U.S. 10-year Treasury.
Yeah, it is ever, yes.
As ever, okay. And then you've got, on the other hand, the B of A Global Fund Manager Survey that shows that they're the most overweight bonds they've been in 14 years. So one of those is going to have to emerge as the right bet here. What's your outlook for bonds right now?
So just real quick on that, what the other point I was trying to say is that I do think that from an investor standpoint, contrarian opinion is a very good way to basically invest when everybody's all on one side of the boat, too bearish or too bullish, that the markets tend to go the other way because you've kind of exhausted all of the buying or selling pressure when everybody gets on one side of the boat. And the reason I brought that up was that's easy to say. It's very, very difficult to measure because you've got two measures here of the bond market that are saying pretty much polar opposites of each other. Although the commitment of traders measures more short-term players and the B of A fund manager survey is a little bit longer term, but they have polar opposite views of the market. So that has always been the problem with contrarian opinion, is that I love the concept. It's just, is everybody bearish or bullish? And usually the answer is yes to both at the same time, because you can always find measures that contradict each other. As far as the bond market goes, yeah, I think that, there was a moment there after the banking crisis in March. I thought that maybe we saw the peak in interest rates because I thought we really broke something that was going to change something big, but it doesn't appear that that's come. So we're kind of reverting back to the pre-March trend that we've had in markets where they kind of continue to interest rates, where they continue to meander higher. And the yield curve gets more inverted because short rates are going up faster because the Fed is perceived to be more aggressive as we move forward. And because of that, I do think that we're going to continue to see that competition for stocks to get even harder. Because if rates go up, why should I take the risk in the stock market when I can get most of it without any risk? So I definitely see rates going up. Now, if we see signs that the economy is really broken, or there's an event that happens that changes things, or we see signs that maybe there's something more going on than just a base effect in inflation from going to 9 to 3 and it keeps going down. I think it's a base effect. I think it bottoms at 3 and it starts drifting higher. But if I'm wrong on that and it bottoms at 3 and then keeps going lower, then we could definitely see, I'd have to revise that outlook. But right now, I still think that interest rates are where everything begins. That's the 2010s to 2020s. Everything began with 0. And that's why you saw everybody push into this Tina FOMO type of stuff, that there was no alternative. But now there is an alternative, 5.5% on no risk. That is an alternative in the marketplace right now. And we'll see. And by the way, that 5.5%, other than 8 stocks, is very competitive with everything else this year. Oh,
absolutely. Yeah.
Yeah.
The S&P, 492 haven't done anything this year, and you've taken on equity risk. So you'd much rather be in the 5% T-bill, right?
Right. And if you bought the index itself, you're very exposed to those AI stocks, and whatever happens with the AI stocks next. Look, they could go up or they can go down, but you're basically making a bet on AI if you own SPY, to just use an example. So I think interest rates are going to go up. I think the yield curve is going to continue to get more inverted. And I continue to think it's going to exert more pressure on the economy until we see either A, the old line that something really breaks that causes the Fed to change policy, or we see signs that, inflation is really as vanquished as the New York Times says it was this morning, and that we're now doing postmortems on it when I'm not even sure it's vanquished to begin with.
Okay. So I just want to ask this follow-up because we've been talking a lot about bonds over the past couple quarters now, and most retail investors don't have a lot of experience with them, right? Yeah. So would you say that now is a good time to be buying into bonds, and maybe on a dollar cost average basis? Reason being is you're now getting a good return, right? And even with the expectation that rates may be going up, one is you're buying in, you're obviously getting buying in over time, you're getting the higher rates. But there's a potential play here for bonds, and I don't want to oversell the confidence that this is going to happen. But if something does break and there's a safety trade, or the Fed gets inflation under control and decides, okay, we're done hiking and eventually we're going to start cutting again, or the Fed is forced to step into rescue with cutting, right, because something really bad happens, that eventually, if rates start coming down at some point in the future, not in the short term because you expect them to go higher, but let's say later this year, early next year, let's say there's a Fed pivot, you could see rates go down pretty substantially and get, substantial appreciation in bonds if they're longer dated here. So right now we've had some capital managers that are beginning to go out on duration. I don't think anyone's going whole hog yet, at least the folks that we're talking to. But do you think that is a good strategy to consider here, or do you think rates are going to go higher for longer so much that those folks that are waiting for that potential appreciation might be disappointed?
So a couple of things about the bond market. Beginning of last year, rates at the front end were zero and rates were at historic lows. So when you remember with bonds, the phrase we use is total return. You take the coupon that you get with the bond plus the price change. And last year you had no coupon, or you had a very small coupon. And then when the Fed started raising rates and the prices fell, you didn't have that coupon cushion, and you wound up losing nearly as much money in the bond market as you wound up losing in the stock market. Not as much, but close. So it was the worst year on a total return basis that the bond market has ever had. Well, the dynamics now are very different. There is a big coupon in the bond market, a 5% yield. You get 5%. Now, if the Fed keeps raising rates and the price declines, you've got that coupon to cushion you so that the losses that you would look at going forward might not be losses at all. They just might be small gains. But the thing that bonds will offer you is safety. They won't go down a lot anymore because there's a coupon. If there is a problem that causes the economy to go down or anything else, there is a rush to safety in bonds, and then their price rallies and they provide you with a good hedge, which is the basis of the 60-40 portfolio. The 60-40 portfolio didn't work as much last year because we started with no coupon. But now that we have a coupon, an interest rate to cushion any change in any fall in the price, that changes a lot of things as far as bonds go. And finally, I would say when you talk about bond managers, now that there's a coupon and there's price volatility, there is opportunity for fixed income managers to actually make money or actually earn their pay or earn their alpha, whichever phrase you want to use. Because 2 or 3 years ago, every rate was rock bottom. Everything was dependent on the Fed. There was going to be one event that was going to cause all the prices to go down, which happened last year. But it was really hard to say, I want to, as a fixed income manager, I want to invest in these sectors and not invest in those sectors and provide some outperformance, because it never really happened. But now, from this moment going forward, fixed income managers can separate themselves from other fixed income managers by investing in corporates or in high yield or in treasuries or the shape of the yield curve or their duration or structures like mortgages, or avoiding some of those if they think that they're more problematic, and provide a much above average return than the index. It's going to be a lot more opportunity to outperform the index now than it was a year ago. So yeah, bonds have become an interesting place. Are they a place where you're going to make a ton of money fast? No, you're never going to do that unless you take a lot of risk. And that would be more in private equity and in stocks and in high yield. But are they a place where they can provide you a consistent return that's always positive, much better in good years, less so in leaner years? Yes, because there's a coupon now that you could maybe look almost always towards a positive return, or if there is a loss in bonds, it would be a very small loss. But that would mean because there was a gigantic rise in interest rates, which would probably hurt the stock market a little bit more. So the world of bonds, as I like to say, we're returning to where I got into the bond market in the 80s and 90s, and it's more looking like what it was in the 80s and 90s when there was actually bond managers. You know, when Bill Gross became Bill Gross at that point, because he could separate himself from everybody else because there were so many opportunities. But from 2010 to 2020, what were the opportunities when you had no coupon and everything was just trading on top of each other? Well, that's changed now in a big way.
All right. Oh, fascinating. All right. I'm going to have to end it there, but it'd be fun to dig more deeply into this next time you come back on, and we'll be even further into the bond story by then. Jim, this has been great. Look, for the very few folks who might not have been familiar with you before today's interview, but have really enjoyed it, where can folks go to learn more about you and your work?
Well, three ways. We offer work for the institutional investor at biancoresearch.com. You can request a free trial, especially if you're in that space. If you're not in that space, I try to stay active on social media, either at Bianco Research on Twitter or on my LinkedIn account at Jim Bianco.
Jim, a great discussion as always. Always love it when you're on the program. Thanks so much for giving us so much of your time today.
Sure. Enjoyed it as well, too. Thank you for having me.
All right. Well, now's the time in the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Wealthion, to react to both what Jim said in this interview, as well as talk about what the markets have been up to in the past week. I'm joined as usual by lead partners from New Harbor, John Lodra and Mike Preston. Hey guys, Mike, why don't we start with you? What are some of your key takeaways from this discussion with Jim?
Hey, Adam, good to see you again. Really good interview with Jim. Enjoyed it a lot, and jotted down a few notes that I'd like to just briefly mention here. In response to your first question, I think this the same first question you always ask, what's your take or your outlook for the global economy and markets? Jim says it's surprising to the upside. Well, there are a number of things that are surprising to the upside. Most importantly, the stock markets. The stock markets have been on a tear, literally starting almost from the first of the year. The NASDAQ is up 37% or so, 36%. The S&P is up close to 10%. Interestingly, the Russell 2000, even though it's had some strength in recent weeks, is relatively flat on the year. It is up a few percent now because there was a move in the last few days or last week. But it's really been a market of just a handful of stocks, like you both talked about during this interview. And we have seen that participation widen out a little bit, but it's very unclear as to whether this is a brand new kickoff, a brand new bull market, as you see all over the news these days, because we've had a rise of 20% off the swing low or the previous bottom in October of 2022. We don't think it's a brand new bear market, a brand new bull market. We think there's lots of reasons for concern, some of which I think we'll probably talk about later in this video. But Jim says surprising to the upside. He's absolutely right in some regards. Employment report came out recently, very positive, surprise to the upside. But predominantly, it's the markets that are surprising to the upside. And the question is always why. There's been a lot of talk about liquidity. Liquidity has certainly been a big factor in recent years. The question is, will liquidity be the only thing that matters, the only game in town forever going forward? We think probably not. And Jim lists some pretty good metrics on how to measure liquidity. He talks about the balance sheet. Well, the Fed's balance sheet is around $9 trillion or so. It's reduced a little bit, but hardly even noticeably. Reverse repos and the TGA, the Treasury General Account. The Treasury General Account has recently been refilled to some extent. Jim talks about it's probably done through the repo facility, which doesn't necessarily take liquidity out of the market. That may be true, but All of these are details I'm not even sure everyone needs to worry about, because there is an alternative now. That's really the key. There is an alternative. 5% safe money. Short-term treasury bills are at 5%. And so there's less incentive, really, for that liquidity to find its way into the stock market. I know that we want to have a never-ending reason oftentimes for the stock market to perform well. Generally, people like that. 401k balances go up and politicians get reelected and that type of thing. But at the levels of valuations that we're at, which are exceeding or at levels that we've only seen a couple times in history, liquidity may not continue to be the only driver in market returns going forward. A couple other things that he said. Powell, the Fed chair Powell, paused in the most recent Fed meeting. He thinks it was more of a political decision, that the Fed wanted to have a unanimous vote. And to get the unanimous vote, they decided to pause. And Jim thinks they'll probably have one or two more rate hikes, maybe 25 or 50 basis points more. That doesn't really matter that much, though. We just went from zero in March of 2022 to 5% interest rates, with Fed funds rates to match or at least similar. So that was really the biggest move, or the largest move, one of the largest moves in history. I think actually the largest one in such a short period of time. And here we are 14 months later, still waiting for the ramifications of that. Historically, there's 12 to 14 months before the waves start crashing to shore, so to speak. They're likely going to start having ramifications soon. It's puzzling that they haven't. And he talked a little bit about these, the handful of stocks that have been driving this market. And he says he's not necessarily averse to holding on to overvalued stocks. And if you're in the first early stages of a bull run, his opinion is that to hold these types of stocks now with a hostile Federal Reserve and inflationary pressures is asking for trouble. We couldn't agree more. We think we're in a dramatically overvalued market. Maybe Jim doesn't think, maybe we think that it's even more overvalued than Jim thinks, but I think we're in agreement that the market's overvalued and that holding on to darling stocks during that time is a dangerous thing. Lastly, Jim talks about bonds for a risk to safety trade. He mentions that bonds are a good thing to hold, particularly if we get a drop in the S&P 500, money will flow into safe assets and probably look to nail down long-term positive interest rates. He points out if you buy a bond, you're getting paid a coupon, 3%, 4%. And if it's a short-term T-bill, it's a much higher coupon. But right now on long bonds, 3 or 4%. This is money that comes into the account that offers forgiveness if you're early and you're underwater on your bonds. Don't forget that the coupon payments smooth things out over time. And lastly, we think that these assets will drastically increase and jump in value, particularly if we get a risk-off event and the S&P drops precipitously, which we think it's likely to do. So I'll take a pause there.
Okay, those were great summaries there, Mike. John, I want to come to you to let you add on to that, and then maybe we can talk briefly about today's news with the latest statements by Fed Chair Jerome Powell, which sort of dovetails into some of Jim's warnings that inflation may actually not be tamed here, that it actually might start creeping up this summer. But what else would you add to what Mike said there?
Yeah, we always love seeing Jim and your guests, repeat guests, Adam. They always come with great perspective. Yeah, I want to kind of pick up on Mike's acknowledgement. So we have had a very narrow market this year, and we have seen a broadening of late. It's not a dramatic broadening, but it is broadening nonetheless. But we're already starting to see emblematic kind of feverish overzealousness about a new bull market. In fact, I'd like to share a couple of slides just kind of put things in context. Somewhere along the line, and hopefully you can see this, somewhere along the line, someone decreed that a bull market is a 20% up move, right? Can you see this chart okay? I think you can.
You can, yeah. It's the kiss of death, the Barron's cover.
So it's fabled history to look at magazine covers, and the more bombastic or more shiny and glitzy they are, usually the better the contrarian indicators. But this is a recent one. I think it's June 12th, about a week ago. Barron's, kind of a glossy, shiny bull here saying this market has legs. All well and good, but let's keep in the context here what a bull market can look like, especially when we're talking about overvalued markets. So here's the tech bubble crash in around the year 2000 to 2002. And you can see this is for the S&P. The NASDAQ was even a worse decline than this, but all the way along what ultimately was an over 50% peak to trough decline in the S&P 500, there were very dramatic bull markets, several of which crossed that 20%, threshold that decrees a so-called bull market. So oftentimes in a highly overvalued market that is really a bear market that's consolidating a lot of excess, these are what really should be called bull traps and really bull market rallies. And we think that we're likely in that. And just kind of emphasize the point, this is in the great financial crisis of 08, 09, same kind of thing. We saw, several very strong rallies, even though peak to trough in the S&P was over 60% decline from late 07 to early 09. I did also want to comment about this debate about liquidity. That's been a common thread in a lot of your interviews lately, Adam, and it's understandable because the last decade has all been about QE and money printing and flooding the economy with massive amounts of base currency. Now, I think what's unfortunately lost in a lot of this debate is that, and Mike touched upon this, and so did Jim Bianco, you now have cash that has a rate of return over 5%. This is just another chart that I want to bring in. This is Morgan Stanley's Mike Wilson put this out, and it's just showing. I don't want to make too much splash about this chart, but because to your point in your interviews, Adam, there's so many different ways you can measure liquidity, and frankly, you can tease any chart to kind of make a case. And this one happens to show a divergence between the S&P 500 going higher and a decline and stalling of global world money supply from the central banks. So that's one that flies in the face of this simplistic suggestion that more liquidity means higher markets. And
hey, John, sorry if I can just jump in there for a second. So what Jim, I think, would say, and I'm now confusing my interviews from this week. It was Jim or it was Sven Henrik, but it was that because it is a sort of tricky measurement, liquidity, money supply is part of it, but not all of it. And basically, I think it was Jim was saying that you can go into things that are capital can flow into things that are not defined by traditional measurements of, say, money supply or liquidity. So in other words, like bank reserves or things like that, or money market funds, right? So it's not that yes, the world money supply may be shrinking in the way that it's being measured here, but those balances of those other things I mentioned are going up dramatically, and they do impact total liquidity in the way that it can drive asset prices. And I'm not pointing out to say this chart is wrong. I'm saying it's probably incomplete and it's tricky to measure this stuff. So I like I said, I keep asking people their preferred measurement of liquidity because there's so many different variants of it out there. To your point, you can look at one and say, oh, maybe it's flatlining. You can look at another and say, oh, it's growing, right? So it's a challenge for us to be able to track this, is what I'm saying.
That's exactly the point I want to emphasize. I'm not doing a great job at it because really the point I really want to make is that the devil's in the details of what that liquidity is represents, right? So for much of the last decade, that liquidity represented oppressively low rates of return, right? So it incented all manner of folks to go out and chase anything with a yield, junk bonds, stocks, anything but 0% interest at the bank. The last year has changed that dramatically. And here's a chart showing the earnings yield on the S&P, which is just a way to kind of make equivalent the yield on stocks as compared to treasury bills, the 3-month treasury rate. That is actually the earnings yield on the S&P right now is below 3-month treasury bills, and it's right around where U.S. corporate bonds are. The point being is that this idea that massive amounts of liquidity is just itching to go into other things conveniently ignores that, and here's another look at the excess earnings yield of the S&P as compared to 3-month treasury bonds. You can see we've gone negative here. Last time we were there was at the really pinnacle of the tech bubble. It can get worse, of course, but to say that simplistically that more liquidity means things going higher really ignores that this liquidity now has a pretty compelling rate of return. And Jim himself in his interview pointed this out and said, look, Ibbotson talks about the long-term rate of return for stocks at 9%. If you can get 2/3 of that in essentially a risk-free asset, why the heck would you be heavily invested in stocks right now? That's
right. Why would you take the equity risk? Right. Exactly.
Absolutely. And that's very much our view on the matter. So I wanted to, I think, and let's take this thought experiment to an extreme. Let's imagine that money markets and T-bills were earning 10%. You know, they're 5.25%, let's say right now. Let's imagine we're earning 10%. Do we think T-bills at 10% would still have this burning desire to go in the stock market? So it's arguable, where's that threshold to where the short-term yield is compelling enough to stamp out that speculative frenzy? We think we're getting pretty darn close to that, especially as people have become awakened over the last several months, especially in this bank run or bank walk, whatever you want to call it, that there is an alternative to 0% cash at the bank. So really, really important point that I think we want to emphasize is that there is an alternative, and liquidity that's no longer trapped at 0% return is a whole lot different than liquidity that's earning a pretty compelling rate of return.
So great point, Sean. I just want to point out, you guys are probably pointing out where the puck is headed, right? In other words, as safe rates continue to rise here, right? Eventually, at some point, enough capital is going to, critical mass of capital will say, all right, you know what, fine, forget these speculative assets that have maybe now been rebid up to really excessively high level of valuations. And I'm just going to go park myself in bonds and get a nice, safe, fat return, right? That probably is where the puck is headed if these trends continue. I just want to contrast that with where we are right now. We've had so much money over the past recent weeks, just flood into what they're now kind of calling the mega 8, right? The 8 largest cap stocks in both the S&P and the NASDAQ now. They're the same 8 companies. We have just bananas valuations. We've talked about NVIDIA a lot, but we can talk to a lesser extent about a number of the other companies in that basket of 8. But also much more speculative assets like Bitcoin has gone from 25,000 to today, as we're talking, it's over 30,000 in just a matter of a couple of days. So there does seem to still be a lot of hot speculation in the market right now. Just curious your thoughts on that.
Oh, no doubt about it. I think that magazine cover that we started the slideshow says it all. No doubt about it. And we don't have a good answer to that other than say, man, are you investors wanting to be careful about your hard-earned retirement savings, or are you speculators and do you want to go buy an NVIDIA at 40 times sales, where you got to return every dollar to shareholders for the next 40 years to justify the current revenue levels, to justify the valuations. Sometimes those kinds of things are best to be avoided. And broadly speaking, we see rampant examples of that. But we have to give acknowledgement, and we did last week, and we will do so again. There has been some broadening of the market, especially in some areas that aren't so crazily overvalued or so sought after by speculators. We've noticed material improvements in things like industrials, old school industrials, biotech, even energy is starting to see some technical strength, even though it's still lagging on a relative strength basis, and we think a little premature. Point being is there are things underneath the surface that we are looking very closely at, and will likely be making some tactical exposure increases, offset with some hedges probably, to navigate, we think, a bifurcation of the market that is a super overvalued broad market, especially in these segments, but some areas that are starting to look like they're gaining their footing and starting to perhaps get ready for a rotation.
Great. And Mike, let's talk about that for a second. So, what John's talking about is a ton of capital has flooded back into this market. To date, it's gone into these high flyer AI stocks, AI driven stocks mostly. But now we're beginning to see the rest of the market begin to come alive. And there's a lot of stocks that had kind of been left for dead after last year's punishment that may now get a good ride as capital starts to maybe rotate a bit out of the white hot AI stocks. Real quick though, before we talk about what you guys are looking at doing, I just got to express my consternation, my confusion that at the end of 2021, everybody still was convinced, and they'd been trained that the Fed had everybody's back and don't worry about market valuations because stocks always go higher. But then reality punched them in the face last year, right? I mean, 2022 was a really rough year, right? No place to hide in stocks or bonds. A lot of people saw their portfolios go down by 20, 30% or so. And what surprises me is the speed with which people have rushed back in to the speculative side of the market, right? I would have figured that I can understand money coming back in because maybe things got too oversold, by the end of the year, by the October timeframe. But the way in which capital has piled into these hot, AI stocks again, it's almost like people just kind of learn nothing in terms of caution or being wary of excessively high valuations, because the valuation in those top 8 stocks, they are really stretched by any metric. So I'm just curious, why do you think people have just returned so immediately to loving speculation again after a really recent hard lesson?
Because people love to feel good right now. They don't want to wait. They want to have the positive reinforcement of what they perceive to be immediate gains, and oftentimes the momentum does continue for a little bit longer than you think. I know of one money manager that I read about, a pretty famous hedge fund investor, that said, if I see a bubble, the first thing I'm going to go do is jump in and try to push it further. Because it can work. If you've got lightning fast trading and you've got advanced systems, it actually makes sense from an immediate short-term perspective, because momentum tends to, in general, go longer than you think. But it's very dangerous. And if you don't have good stops or good exits, or at least iron steel discipline, you're going to be in huge trouble. And most people don't have that. Most people just pile into these things, and money managers included, institutional money managers, pile into them without a really good exit plan. When things reverse and the market reverses hard, and it does, what has become a short-term decision becomes a long-term investment. And that's where emotional discipline is really important. I think that's what we help with more than maybe even more than a lot of other things. We help with emotional discipline and act as a sounding board for people that are having this fear of missing out. The neighbors are bragging, that type of thing. So I started in this business in 1999. What a time to start, and witnessed the final blow off stage of that tech bubble. And it was all the same back then. In my opinion, it's even bigger now. It was very narrow back then. It was a handful of stocks. It was the 4 horsemen of technology, that type of thing. But that market was devastating to a small group of technology stocks. We didn't learn from that, and then we reinflated the bubble into the housing crisis. And we here at New Harbor saw that coming a few years before it actually peaked. And that one went longer than we thought it could. And, because of our defensive posturing and our ability to use options, we were able to ride that out pretty well. But then after the housing crash and the Great Recession of 2008 to 2009, I got to be honest, nobody could have imagined the amount of stimulus that would have been thrown at this market, this system, over the next 15 years. And so we're in the everything bubble, and this bubble is bigger than all of them. And so it is really no surprise that human nature, being what it is, hasn't changed. People like short-term rewards. They like to feel good on a short-term basis. They like to look good on a short-term basis. And if things change, there's always justification, or at least there's a lot of other people in the same boat as you that feel just as bad. So that's why it's really hard, particularly during historical bubbles. And this is, I think, the largest one any of us will ever see and have ever seen. It's incredibly hard to do something different. We try to do that. We're still heavy cash, although John mentioned we're looking at a tactical long trade with hedges. But really, I mean, if this market goes further in a straight line higher to really make money in it, you've got to go all in. And given the set of circumstances and the data, we're just not very likely to do that. In fact, we're not going to do that. The most we would do is a smaller tactical trade in high relative strength sectors, because our very short-term indicators have reversed up into the positive. So just to recap, I don't ever expect human nature to change, ever. Potentially, or perhaps if we get a real wipeout, it could change for a generation or so. There's a lot of writings about the Great Depression and people that swore off stocks for the rest of their lives. But it always comes back. Things go in cycles. And, lastly, I think we're in the climax years of a fourth turning. You had Neil Howe on this program not too long ago. And he, by the way, is coming out with a new book, I believe, next month that I look forward to reading.
And just to let you know, I got an advanced copy of it from his publisher. So it's sitting on my nightstand for reading. He'll be on the channel in August. So we will have him back on this program for all you fourth turning fans to get the latest.
Look forward to that. For people that don't know about the fourth turning, essentially it's a generational theory. And the punchline is that we're in a fourth turning, the climactic phase, the time of greatest risk. And finally, we're probably in the 5 to 6 years, the ultimate 5 to 6 years of this fourth turning. So couple that with the most extreme valuations in history, the all-in belief that the Fed can do no wrong, that liquidity is the only thing that matters, that the Fed is the only thing that matters. The Barron's cover that John just flashed up on the sheet earlier, or on the screen earlier. There's a lot of caution that's warranted here. And I'm not surprised that people are piling into these darling stocks, and they might go a little bit further, who knows? But ultimately, even if the market advances a little bit from here, I think it will be a lot lower than here in the next year or so. And so we're managing accordingly.
All right, thanks. Good answer. And John, I'll give you a chance to opine on that. Just in the sense that, I get Mike's perspective that, hey, look, human nature is going to change, not going to change until, they really get burned, badly enough to change that perception. But when I look at things like, we now have record call buying on the S&P, right? So, that's exceeding the levels that we saw back in 2021, early 2021, when meme stocks were raging and people were getting checks in the mail, and the Fed was still keeping rates really low. We had just an environment that was much more conducive to speculation back then, and yet the speculation is even higher at this point in time. And another thing that's very different is the Fed. The Fed, finally became a disciplinarian, raised rates super high, fast, is now doing QT and whatnot. But even on the day we're speaking, while the Fed did announce a skip last week, Powell came out today and told Congress, hey, we have, quote, a long way to go until we get inflation, anywhere near where we want it to be, under 2%. So, Powell is essentially saying, hey guys, I'm not going to come to the market's rescue anymore, right? I'm not going to be that easy accommodative guy. In fact, I've taken the cost of capital really high, and I'm going to probably take it higher from here. He said basically almost everybody on the Fed voting board is expecting to have to do, 1 to several more rate hikes this year. And I just want to underscore another thing that Jim said in this interview that we just watched, which is, he walked us through the math of the base effects and said, hey, that's actually been bringing, CPI down pretty aggressively in these recent months. But he said, if you look at the base effects, they actually should start driving inflation back up starting in July for at least a couple of months. And so we can tell when the Fed starts seeing that, it's going to look really bad optically to the world that, oh my gosh, the Fed's losing control of inflation here, which is highly likely going to influence the Fed to be even more aggressive going forward. So I just find it look, we can always, what do they say? Like never underestimate, I don't know, I'm mangling this, but just the bad decisions that the general public, can make, something like that. But it doesn't take too many neurons to put those pieces together that I just mentioned, which really surprises me that people are still willing to be as speculative as they are right now. So anyways, I'll let you react to that, and curious to hear your thoughts on what Jim was saying about inflation possibly going up from here.
Yeah, I mean, the base effect math is pretty simple, and it's likely to see that. And one of the things we humans are plagued with is we make assumptions about things that are just assumptions that aren't really grounded in fact. One of our favorite fact-finding analysts is John Hussman. We reference him all the time because he does great work. One example of this, we've talked a lot about, and your guests have pretty resoundingly talked about the likelihood for recessionary type things to take root later this year. We are in that camp as well. The employment picture has been one of the most stubbornly positive things, but that's a intrinsically lagging indicator. That's usually the last thing to kind of hit. But many people make the false assumption that recession means inflation drops, which is actually not what happens. John Hussman's done some great work, for example, to show that inflation oftentimes stays flat or maybe even rises a bit in the first year of a recession. So it's entirely possible that we could have this situation where we have a Fed having to stay hot on policy to keep inflation in check, even while recessionary forces are starting to take hold. These are the kinds of things that are so ingrained. And it's not surprising that after a decade of what amounted to be the biggest torture chamber psychological torture experiment in monetary policy, that people have a continuing, very speculative and very tortured set of psychology as relates to markets. We have had a decade. This is a decade of unprecedented monetary policies. It'd be naive to think that these kind of ingrained behaviors would be just sniffed out overnight, right?
Yeah, it's true. It's probably more Stockholm syndrome at this point, but yeah.
So and I think back to your point, your original question, we kind of agree that there's probably a decent chance that we could see sticky inflation because of some of these baseline numbers, and the fact that recession doesn't mean disinflation and this and that. These are things that are oftentimes rooted in perception rather than reality.
All right. Well, look, in Powell's comments today to Congress, he said, quote, "The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation." So, that's basically him saying, look, everybody, get ready for pain, right? The pain that he was mentioning earlier, like to keep inflation under control, I'm going to have to do stuff that's going to slow the economy more, meaning probably going to be a recession. He said hiring, that's, I think, code for sort of like expect jobs to finally take a hit at some point in here. And inflation, it's may prove stickier than we think. And so we're going to have to be really tough to bring that sucker down, right? So, Powell has been, if anything, he's been very consistent over the past year. And, as we've talked many times in this program, the market has pretty much always shrugged off what he said. And what's interesting is the market has actually had to adjust its expectations over time. So in this game of chicken between the markets and the Fed, it's the market that's been having to blink. The interesting thing is it really hasn't impacted the market's enthusiasm to rise in the face of all this. But as we talked about with Jim, there's two very different stories being told right now by the bond market and by the stock market. And one of them is going to have to prove right here. And historically, the bond market usually is the one that's proven right. Most really serious Wall Streeters, respect the bond market's predictive abilities way more than they do the stock markets. Who knows what's going to happen from here? But I just want to underscore, the point we're all making here, which is the current enthusiasm in the stock market. Unless you can make a really good case that more and more net positive liquidity is just going to be shoved into this market, there just does seem to be a lot of reasons to be wary. So this is not necessarily a time to go whole hog in, particularly in the sectors of the market that have risen so far so fast. So totally get that you guys may be making a short-term oriented tactical play in some of the more defensive parts of the market that you think may now rise as some of the capital rotates out of the hot AI sector. I totally get the reasons for that trade. My guess is, though, as you make it, you're going to be putting in safeguards just in case. You tend to do that right before the general market corrects, and so you're going to have some protections against that. I see you guys nodding as I'm saying this. So, Mike, as we wrap up here, you know, I guess I just sort of gave my little summary here, but what summary / parting counsel would you give to folks that are, you know, watching the growing euphoria going on in the market and feeling that FOMO temptation because their, you know, neighbor who's just been blindly throwing money into the markets had a really good year so far?
Adam, I believe it's just a relief rally. I honestly think the top of the market was likely January 4th of 2022 in the S&P. This has been a giant relief rally, and I'm not saying it can't go higher, that it maybe even the highs can't be exceeded. They certainly can. My belief is that this is a very long, drawn out relief rally. That we had a bottom in October of 2022, the S&P down 20% or so, maybe a little bit more, and that it's been straight up since there. And it's retraced a good amount, over 80%. 78% is a Fibonacci number for the Fibonacci followers. We've actually gone past that. So it's been a long, drawn out affair. And so speculation is back. We're chasing the same old hot stocks. Valuation is no concern, and volatility is in the basement. VIX is down at 13 or so, which is a volatility measure. It threatens to go to 12. So given everything else we're talking about here, and admitting that we might do a short-term tactical hedge trade, we're very concerned that this is just a relief rally and not a return to normal. I know that we all want to believe it's a return to normal, but I think it's very unlikely to be that. And as such, we're going to have hedges. We have hedges on what we've already got. We have a high level of cash, about 40 to 45% for most people at present. That will drop if we do a short-term tactical trade. And this market moves fast. You recently had Sven Henrik on. We had a chance to look at his video as well, and his interview with you. And he mentioned that the options market is just, the derivatives market is so complex, and there's so much participation there that it causes very rapid movements in markets. So this melt up, so to speak, at least so far that we've seen, has been probably exaggerated in speed, particularly amongst those few stocks that we talked about, but also downside moves. They can happen incredibly quickly. 1 or 2 or maybe 3 days could erase all of the positive short-term bullish signals we've seen so far. So it's tough. We tend to be slow moving. Sometimes we're criticized for that. Sometimes we're complimented for that. And so, when we're moving into the market, a lot of things have reversed up. In this type of market, oftentimes that's right before the reversal. So you have to be careful. So, be careful with FOMO, or fear of missing out. Don't compare yourself to others. Try to have some patience. Watch videos like this. Read works from people like John Hussman that John mentioned earlier, that puts data out there that makes it less emotional for you, and so you won't make mistakes. And we're here to talk. If anyone wants to talk, that's what we're here for.
All right, great. Well said, Mike. I know I'm going to get some grief from people saying, come on, guys, the markets are up this year. We had a terrible year last year. And even when the markets are up, you guys find ways to be bearish. Like, can't you just enjoy, the ride and people making money? Right. And I want to be the first to say, I can't wait to be able to be having discussions with you guys about companies that are at attractive PE levels, right? And talking about attractive cash flow multiples. Maybe an environment where interest rates are starting to come down, right? And we can talk about, capital flowing out of the safety of bonds into good value companies and whatnot. I can't wait until we have a target-rich environment to be able to encourage people to be more enthusiastic about the markets, just for all the reasons that we talked about here. I don't feel comfortable doing that. I can't really tell that type of story except looking at liquidity flows and just technical levels, right? Okay, we just punched through, technical level X, so therefore probabilistically we might go a little bit higher in the short term. Those aren't long-term sustainable reasons to be taking, long-term long positions that most investors want to take. But just to be clear, I'm not trying to rain on people's parades. I'm just trying to help people make eyes wide open assessments of where things are. All right, guys. Well, another great week. Thanks so much for joining us here. Folks, for all the reasons that Jim mentioned in this video, as well as the ones that John, Mike, and I talked about here, continue to highly recommend that most people watching this who want to preserve and grow their wealth going forward should do so in partnership with a good professional financial advisor who can help create a personalized portfolio plan for them and then execute it for them while keeping them obviously very well informed along the way. If you have a good one who's doing that for you, excellent. You should stick with them. They're very rare. But if you don't, or if you'd like a second opinion from one who does, maybe even John and Mike and their team there at New Harbor, then consider scheduling a free consultation with one of the financial advisors that Wealthion endorses. To do that, just go to wealthion.com, fill out the short form there. You can set up one of these consultations. Like I said, they're totally free. They don't cost you anything. There's no commitment to work with these guys. They just offer it as a free public service to help as many people as possible position prudently today for what might happen tomorrow. And if you enjoyed having Jim on this program and would like to see him come back on again in the future, please do me a favor, cast your support for that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. John, I'll let you have the last word as we say goodbye to folks here.
Thank you again, Adam, for having us as always, and to the viewers. We are happy to talk, answer questions. We are in a very tricky markets. There's no doubt about it. The cross currents here are dramatic, and we think deserves a very open-eyed look at things and not get seduced into believing that everything is just all peaches and cream. There's many cross currents here that deserve a real hard inspection. And we know it was a tough week for you, Adam. We've talked about it, and you've shared some very touching moments about your mom's passing, and we're glad you're back here, and our hearts have been with you. It's a very sensitive topic that we oftentimes talk to clients about is late stage care and the financial aspects of that, but a very, very tender time in your life, and we appreciate you being here despite all that.
Oh, thanks. That's very kind, John. Very much appreciate that. And yeah, that's something that we should talk about at some point more on this program. Just sort of planning for senior parents, end of life needs and the transition. I certainly learned an awful lot that I didn't know before going into this process. Some of which can help people, and hopefully some of which I can, pitfalls I can hopefully identify for people to avoid going forward. So big topic, but yes. And thanks so much to everybody for all the kind words that folks have been sending in. Incredibly grateful for everybody's support. And the long and short of it is as sad a time as it is for the Taggart household, we're very grateful for what a really wonderful passing my mom had. I'll share the details at a later date, but it really went very gently for her, and that's the best we could all hope for. So anyways, thanks so much for the kind words. All right, we'll end it there. John and Mike, thanks so much for joining me this week. Look forward to seeing you guys in the program next week. Everyone else, thanks so much for watching.
Thank you, Adam. Thank you, everybody. See you soon.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.